Have you ever wondered why certain stocks spike or crash suddenly without any apparent reason? Or why some traders seem to always predict market moves perfectly? Here's the unsettling truth. The stock market isn't always as fair as it seems. Market manipulation is real, it's rampant, and chances are you've fallen victim to it without even realizing it. In the next few minutes, I'll expose every hidden tactic manipulators use to rig the market against everyday investors, and why knowing these could save your financial future. Before we unravel these sinister strategies, let's set the stage. Stock markets were originally built on trust. Trust that each investor has an equal chance to succeed. But throughout history, cunning traders, greedy executives, and powerful entities have found ways to break the rules to enrich themselves. From the legendary Jay Gould and Jim Fisk's manipulation of the gold market in the infamous Black Friday scandal of 1869, to Jordan Belfort's penny stock scams in the 90s, market manipulation isn't new. Regulatory bodies like the SEC, Securities and Exchange Commission, were created precisely to combat such deceptive practices. Yet even today, billions are stolen through subtle manipulations, leaving everyday investors like you footing the bill. So what exactly is market manipulation and how deep does it run? Let's dive deeper. Imagine the market as a stage, where manipulators carefully orchestrate their moves. Rumors and misinformation spread strategically across social media. Insider tips whispered behind closed doors. Pump and dump schemes prepared weeks in advance, inflating stocks artificially before dumping them on innocent investors. In the shadows, traders employ algorithms, coordinating attacks through bots, amplifying artificial trading volumes, and driving unsuspecting investors into a frenzy. In early 2021, a perfect storm emerged. GameStop's stock became a battleground, not only between Redditors and hedge funds, but also among hidden manipulators quietly influencing the hype for personal gain. But first, how do these manipulations begin and what tactics set the stage for massive profits or losses? Now let's get into the heart of it, the specific schemes manipulators use, told through stories and examples that vividly expose the hidden side of financial markets. Starting with the pump and dump schemes, the story of Wolf of Wall Street. In the early 90s, Jordan Belfort built Stratton Oakmont into a stock manipulation empire, immortalized in the film The Wolf of Wall Street. And can you guess what was his weapon of choice? Penny stocks, small companies no one had ever heard of. Imagine hundreds of brokers in a single room, phones glued to ears, calling innocent investors with exciting news about a small startup guaranteed to skyrocket. Belfort's brokers aggressively hyped worthless stocks, inflating their price from pennies to dollars. Excitement spread through greed-driven rumors planted in newspapers, investment clubs, and bulletin boards. When the frenzy peaked, Stratton Oakmont dumped their shares, collapsing prices overnight, leaving everyday investors financially shattered. But this manipulation was obvious. What happens when schemes become invisible, hidden beneath millions of market transactions? Second is spoofing, flash crash of 2010. Imagine it's May 6, 2010. Traders worldwide watched in disbelief as the Dow Jones plunged nearly 1,000 points in mere minutes. Billions evaporated in what became known as the flash crash. The culprit? A practice called spoofing, carried out by sophisticated traders using algorithms. Picture a single trader sitting comfortably in a suburban London home, armed only with a powerful computer. This trader rapidly placed enormous fake sell orders, never intending to execute them. Orders large enough to signal panic, triggering algorithmic trading programs to dump stocks in fear of a market crash. Within seconds, billions worth of stocks changed hands, and innocent retail investors watched helplessly as their life savings vanished in a blink. The spoof orders vanished instantly, but the damage had been done. Spoofing exploits human and algorithmic psychology, creating fear and greed artificially and profiting massively when markets swing violently. But what happens when the manipulation is subtler, almost undetectable? Third is wash trading, cryptocurrency's dirty secret. Let's step into the shadowy world of cryptocurrency exchanges. Imagine this scenario. An obscure crypto exchange suddenly claims $5 billion in daily trading volume overnight. Traders rush in thinking it's the next big platform, but beneath the surface, it's pure illusion. In reality, hidden in anonymous wallets, the exchange itself trades crypto back and forth between its own accounts, known as wash trading, to create the illusion of massive activity. Investors, misled by inflated volumes, pour money into these coins, convinced they're popular investments. When reality finally emerges, prices collapse, leaving investors holding worthless digital tokens. Wash trading thrives where oversight is weakest, luring investors with false promises of liquidity and growth, siphoning off millions before vanishing without a trace. But what if the manipulation came not from anonymous scammers, but from trusted insiders? Fourth is insider trading, Martha Stewart's downfall. One day, Martha Stewart, America's beloved lifestyle icon, got an urgent call from her broker. Sell your shares of ImClone immediately. Stewart acted swiftly. The next day, ImClone's stock price crashed as it announced the FDA rejected its flagship drug. Stewart saved herself around $45,000. But there was one problem. Her broker's information was confidential. Martha's swift action attracted attention, leading to her infamous trial, conviction, and imprisonment. Her reputation forever damaged by insider trading. Insider trading turns trust into betrayal, allowing privileged elites to profit unfairly from secret information, leaving average investors unaware, vulnerable, and disadvantaged. But brokers themselves can also manipulate markets invisibly. Have you heard about front-running? Fifth is front-running, the secret behind high-frequency traders. Picture a brokerage firm processing thousands of customer trades daily. Traders trust the brokerage to execute their orders honestly. But what if, milliseconds before executing a customer's massive buy order, the broker quickly buys the same stock for itself first? This practice, called front-running, was dramatically exposed in Michael Lewis's bestseller Flash Boys. High-frequency traders use lightning-fast computers, co-located next to exchange servers, intercepting and acting on information milliseconds ahead of regular investors. Though milliseconds sound trivial, imagine consistently buying stocks fractions of seconds before giant pension funds or hedge funds do, instantly reselling at slightly higher prices. It's riskless profit earned at everyone else's expense, shaving billions cumulatively off investors' returns. But what if manipulators actively try to destroy companies to make money? And the last is bear raids, how Lehman Brothers fell, September 2008. Wall Street trembled as Lehman Brothers teetered on collapse. Rumors spread rapidly that Lehman was doomed, sparking panic. Short sellers, investors betting on stocks falling, seized the opportunity. They borrowed and sold massive amounts of Lehman stock, aggressively spreading negative news and fueling panic to accelerate the price collapse. The more fear they created, the lower Lehman's stock price fell, and the richer these short sellers became. By accelerating Lehman's demise, bear raids profited enormously, contributing significantly to the chaos that ultimately triggered the global financial crisis. Bear raids weaponize panic, profiting from the orchestrated destruction of companies, livelihoods, and even economies. Now you've seen vividly how each manipulation unfolds, leaving widespread devastation behind. But when the dust settles, what happens next? What's the immediate aftermath, and who truly pays the price? When manipulation schemes unravel, chaos ensues. Investors panic, stock prices plummet, and livelihoods vanish overnight. The immediate aftermath often includes SEC investigations that can freeze trading, locking innocent investors out of their funds. Legal battles, fines, and arrests that bring temporary justice. Public outrage and lost trust, sometimes permanently damaging companies involved. After the GameStop saga, congressional hearings were held, and brokers like Robinhood faced immense scrutiny. Though justice is sometimes served, often those at the top escape with minor fines, leaving small investors devastated. But beyond the immediate losses, what's the long-term damage these manipulations cause? The damage from market manipulation lasts long after headlines fade. Long-term repercussions include loss of investor trust, ordinary people withdraw savings, missing out on growth opportunities, increased regulatory costs. Stricter laws and compliance measures increase costs, often passed to retail investors. Volatile markets. Repeated manipulations create long-term volatility, making safe investing difficult. After the 2008 crash, caused partially by manipulation in mortgage-backed securities, regulatory reforms such as the Dodd-Frank Act emerged. But investors still paid the price through lost savings, homes, and retirement funds. Now that you know this, have you ever personally experienced suspicious market activity? I'd genuinely love to know your story. Understanding market manipulation arms you with the knowledge to spot, avoid, or or even profit safely from market movements. The stock market can build wealth, but awareness is your strongest defense. Next, you should watch how the major market crash happened. It covers shocking real-life cases from history and the one that may be next. Trust me, it's eye-opening, and it could save you from severe losses. If you found value today, please consider subscribing right now. It takes 2 seconds, and you'll never miss critical insights that keep you financially safe.